Uh, Guys, a small error in the calculation part here. I think here the yield was around, instead of 15.25, it was
3.9.
3.92, right?
Yes.
That's a small error in the calculation here, which I can correct. Okay. So now let's start with the second section into this topic, where we are going to understand about the legal and regulatory and taxational issue of the bond. So what did I say? What exactly is a bond? Why do we say it's a bond? Because it's a
Legal contract
between the
borrower and the issuer.
Yes, between the issuer and the lender, or the borrower and the lender. This is a legal contract, right? What does a legal contract describe? Well, it describes everything between the borrower and the lender. It describes the form of the bond, the type of the bond, the obligation, what are the rights of the bondholders, what is the responsibility of the issuer, where is the issuer going to generate the capital to repay, right? What are the sources of income of the issuer? What is the collateral or security provided by the issuer, and so many other details that will be a part of the contract, right? That's called, so the contract between the bond issuer and the bond, the borrower is called as bond indenture. Indenture is the meaning of the contract. Clear? It's also called as a trust deed or a legal document. That's called indenture in bonds. Okay. Now, as an investor, you have to carefully read this indenture, because this will give you the rights. So what is the thing that you need to carefully see? What is the legal identity of the issuer? As I said, where is the issuer going to arrange the funds from to repay you back? That is the source. The collateral, the quality of the collateral, then the credit enhancement. We'll see in a while what is credit enhancement. It's like a credit guarantee, right? And comes the covenants. What is covenants? Covenants are the clause conditions in the bond. All this 1, 2, 3, 4, 5 parts is what we will be discussing in the next slides. So you'll see what is legal identity, what is source, what is collateral, what is credit enhancement, and what is bond covenant. All of these parts you will see in detail in the next slide. So I'll discuss about these parts in the later slides. But these are the important things that you need to take care when you are investing in a bond, correct? Because it would be impractical for the issuer to enter into a direct agreement. Now, first of all, there are several bondholders. Do you think the issuer is going to deal with each and every one of them? No. What does the issuer do? The issuer does not deal with each and every one of them. So therefore, the issuer will appoint a trustee, and the trustees will act on behalf of the investors. Isn't that the same structure when it comes to equities, where the promoters of the company or the management of the company is being handled by the board of directors? So the board of directors represent the equity shareholders, right? So many equity shareholders. In the same manner, for all these bondholders, they are represented by the trustee. Clear? Yes. Now, who can be the trustee? The trustee can be a financial institution like a bank, is appointed by the issuer itself. And the job of the trustee is to act in the interest of the bondholders, right? So what is the major role of the trustee? The major role of the trustee is that the issuer, to check and ensure that the issuer complies with all the obligations, the rules and regulations. The second role, the most important role of the trustee perhaps comes when there is a bond default. So if there is a default, what is the action to be taken by the, what is the action to be taken on the issuer, and how the execution will happen? That all is taken care by the trustees. So the trustees play a very prominent role in, especially in the case of default. Okay. So what happens exactly when there is a default? The trustee is responsible for calling meetings of the bondholders to discuss the actions, and they can also bring legal action against the issuer on behalf of the bondholders. So as I said, they are the ones who will execute, if any, decision on behalf of the bondholders. That's what the role of trustees. Is that clear? So now let's understand each of the importance one by one. First of all, the legal identity of the issuer. Now, you remember who all can be the issuers? You remember that? Issuers, come on.
Governments.
I'll repeat, and you all need to remember this: corporate, quasi-government, states. I said non-sovereign or sovereign governments, right?
Yes.
Sovereign governments, or in a state, in the case of state or any department, who's responsible for you to pay? Who's the one who's going to hold the hold in case if the bond is not paid? That's called the legal identity of the bond issuer, right? So in sovereign bond, what is the legal identity here? Who are you going to deal with? Who is the issuer? It's actually the finance ministry. It's actually those who sit in the finance office, right? That finance department of your country is going to be handling with the bond issue for the sovereign bonds, isn't it? So the legal issuer is usually the office responsible for the national budget management, or the one who administers the bond issue. Everyone. So that can be, as I said, the finance ministry, the one who manages national budget, or can be the central bank of your country. Is that clear? In case of corporate bond, of course, the corporate entity is the legal entity here, is the legal, responsible for you, which can be sole proprietorship, which can be a LLC or a partnership or anything. Correct? Now, we are going to understand a topic called securitization. Now, in that topic, I will discuss at length what is securitization and what is the process of securitization. Unfortunately, before that, it is very difficult for me to make you understand who's going to be the legal entity in case of securitization. But only after that topic we'll understand the process. But in case of securitization, remember one thing, that between the bond issuer and between the entity which has issued bonds, basically here in the securitization process, there is an entity which has actually given loans, not issued bonds, but has given loans, and now is selling this loan portfolio to the investors. But between that, they create a structure which is called a special purpose vehicle, or SPV. So that SPV, or that company which is formed between the company which is selling the loan portfolio and company which is going to invest in the loan portfolio, right, or invest in the securitized bonds, between those is the SPV, and that SPV may be the legal entity in this case. So I'll not go into detail about what is securitized bond, as we will be discussing that at length in the topic of securitization. However, the reason I've kept the notes here is that once you all are done with securitization, and once when you all are revising this particular reading, at that time you can recover this thing. So it's very difficult for you all to understand. I'll just read a few things which I can. Otherwise, don't worry, we have an entire reading for securitization where we will discuss at length each and every word here. So that's the problem with CFA Institute's many curriculum, where most of the things are repeated, as you must have seen in equities first reading also. So the legal obligation to repay the bondholders often lies with a separate legal entity, and that is called an SPV. The legal form for the special legal entity may be limited partnership or limited liability or a trust. The special legal entities are thinly capitalized, and they do not have management, or they do not even have employees. It's just a paper company. I say everyone, it's just a paper company. It's just a company on the paper. They may not even have an office. So all the assets are transferred from one company to another company, and that company then sells the assets. So it's just a transferred company, and that's why it's called special purpose entity. Once the purpose is done, the entity is closed. Okay. So remember, in securitized bonds, who is the legal entity here? The SPV. SPV is created especially for the purpose of everyone. For the purpose of securitization. Once the securitization is done, the SPV is closed. Is that clear? Right? Everyone?
Yes.
Okay. I feel at times that, I'm alone in the session. So I have that habit of keeping on asking. Okay, so do remember here in securitized bond, the legal entity is the SPV. Now comes the sources of repayment. From where are these entities going to pay you back? For example, supranational bonds, they are issued by, you remember the example I told you?
World Bank.
World Bank. So where are they going to be paying you back? How are they going to pay back? Well, they will pay back if some of the countries pay back the principal. For example, let's say World Bank has given India, a loan for slum rehabilitation. So once, let's say after 10 years, if India is able to finish that project and arrange some funds, so once, let's say India pays back to the World Bank, now that is the way World Bank gets the money, and then it can pay back to the bond issuers, right? So the first source from which World Banks get their money is the source of income is that when the previous loans are repaid. The second is when there is a contribution by the members, especially when the developed countries, when they contribute to the World Bank for some aid or in the form of some aid or some relief. That's how World Bank gets their capital, right? So the supranational bonds are, what is their source? They can get money from the repayment of the previous loan or when the member countries contribute. Clear? Sovereign bonds issued by the central government, right? They get money from taxes or collection of penalties or charges, right? That's where they get their money. But what is the other source through which they can repay you back? We discussed. That is by, come on, printing capital, printing currency, right? So those are the two major sources, tax revenues or printing currencies. Which is the preferred one?
Tax revenue.
Currencies, right?
No.
Currencies? No. Taxes is the preferred one, but of course it's a hard thing to do. Sovereign bonds are denominated in local currency are considered safest. Remember, I told you those bonds which are issued in domestic currency are safest, but not in US dollars, right? So if Indian government issues bonds in US dollar, that's not safe. Why? Because we don't have that magic wand for dollar. We just have that magic wand for Indian rupee. Okay. Non-sovereign government debt. Non-sovereign government debt, as I said, the National Highway Authority of India. How would they get money? By collecting taxes or tolls from the road, right? That's how they will get money and they will repay. Correct? For example, let's say a power utility company. How will it get money? When it charges you for the utility bills. That's how they get money. That's how they get their cash flow. Some special taxes can be deployed on a particular project, right? That's how they get revenues and that's how they can pay you back. Corporate bonds, of course, they can pay you back from their operations, from their selling of goods and so on, right? And securitized bonds, as I said, securitized bonds, they are portfolio of loans. So once the borrowers repay the loans, that's how securitized bonds will be repaying the investors, right? So these are the ways through which sources or money can be recovered from the issuers. Clear? Any questions, anyone?
No.
Now, the next two things are very important. That is a collateral and credit enhancement. Collateral means what is the security that is being provided to take the loan, right? Well, if there is no security, there is a high credit risk or a low credit risk.
High credit risk.
So, of course, if there is no security provided, the credit risk is high. So collateral backing is very, very essential. But you also need to review the collateral. You also need to review the quality of the collateral. Investors should review where they rank compared with the other creditors in the event of default and analyze the quality of the collateral backing by the bond issue. Now, collateral, before I go to the collateral backing, you also need to aware that how the credit risk is dispersed among the investors. Do all the bondholders face the same credit risk? No. There is some structure which will disperse the credit risk amongst the different bondholders. That structure is called seniority ranking. So in a particular bond structure of a company, you have secured bonds and unsecured bonds. What are secured bonds? Those bonds which are backed by some financial asset or some financial guarantee. Correct? Some financial asset or some guarantee. For example, let's say I've issued $100 million bond, and against that I've put up a bank guarantee of $100 million, or I have a asset attached to it which is worth $100 million, right? Those are called secured bonds. Why? Because they have a specific claim on the asset. Correct? Now, what is unsecured bond? Now, what I used to believe before I did CFA about unsecured bond is that those bonds which have no security, which have no claim. No, it doesn't mean that. Well, they do have a claim, but on the general asset, not on a specific assets. So unsecured bonds are where there is no backing of assets. Bondholders only have a general claim on the issuer's assets, not a specific claim to a property, not a specific claim to a bank guarantee, but they have a general claim like all others, right? What is the problem with unsecured bonds? They are only paid after. Who are paid first? Secured or unsecured? Well, the secured bonds
Secured.
and then followed by unsecured bonds. Clear? Right? So the structure follows with senior bond and then junior bond, subordinate, and so on. So senior, then subordinate, then junior bond. These are the levels. And within those levels also, there can be a secured and unsecured, everyone. So which bond will be paid first? Secured. After that, unsecured. And then there is a structure, whereas you have a senior debt, means the debt which is issued first. Then subordinate debt, which is debt issued later on. And then junior debt, which is the recent issued debt. Is that clear? So the ranking of all the bonds will depend on two things: secured, unsecured, and which bond is issued first. Clear? Everyone, any doubts?
In the unsecured bond, so like general claim means like
means claim on the entire company. So let's say company has 10 assets worth $100 million. Okay. Now out of that 10 assets, let's say 5 are secured. So from these 5 assets, first the bonds holders which are secured with these 5 assets, they will be paid. Then assume that $500 million is left with the company. Okay. Then all other bondholders will get a share from this $500 million. All other bondholders get a share from this overall $500 million. Clear? But
yes.
First will be paid, the secured ones will be paid because they have an asset, they have a claim on, let's say, asset A. Someone has a claim on asset B. After all those, they are paid. Whatever is remaining is your general claim. That's for everyone. I mean, you won't probably get everything. You may get a share of it proportionately based on your investments. Okay.
Yes.
Yeah. Now, have you realized that there is also a word which we used in bonds very frequently, especially in India, that is called debentures? Right? Debenture is a word which is most commonly used in Commonwealth nations like the UK, the Canada, the Australia, New Zealand, India, and so on. Okay. It's a very rare word that is used in US, by the way. But what is the difference between debenture and a bond? Well, there is technically no difference. The structure is same. However, if there is any difference, that is between secured and unsecured. Secured and unsecured. In US, debentures are generally unsecured. But in UK, they can be secured or unsecured, both. Okay. So in UK and other countries, they can be secured debentures or unsecured debentures. However, again, whether it is secured or unsecured, you'll come to know from the bond indenture. Clear? So there is no difference between a debenture and a bond. Only that in US, the unsecured bonds are called as debentures. In UK and other parts of the world, the debentures can be secured or unsecured. So I've seen people using debenture as a word or a bond as a word. Technically, there's no difference as such. Clear? Now, when it comes to security, I said collateral. So what are the types of collateral backing, or what are the types of securities that are being provided by the issuer? The first type of a bond is a collateral trust bond. Now, collateral trust bond means what is the security provided here by the issuer is another security which can be a share or a bond or any other financial asset. So let's say I am going to the bank to borrow. Let's say I'm going to bank to borrow $100 billion. Now the bank will ask, what is the security you are willing to give? I will say that I am willing to give my 100 million shares as a security, right? That's called pledging of your assets. So most of the promoters pledge their assets. They keep their equities as collateral, and against that they get loan. So whenever there is loan taken against equity, that is called as pledging. Is that clear? Right? So collateral trust bonds, what do? What is the collateral that they take? Another security. Clear? Yes. Any questions, anyone?
No.
Then you have equipment trust certificates. These are generally used by companies which use heavy equipments. For example, companies which use aircrafts, right? For these airline companies, right? They keep the aeroplanes as a security against which they get loans, right? Most of these companies that you see, for example, you may see Etihad, Emirates, or Cathay Pacific, or Ryanair. These are companies, they do not have enough funds to order for 25 and 30 billion dollar of course, I'm not denying that they don't have funds, but I'm saying how they work, how the structure works is that, let's say I'm placing up an order with Boeing or Airbus for 30 billion dollar of planes. So the loan is also given by Boeing or Airbus, and that loan is against the aeroplanes, right? So it's a loan against the equipment. So maybe the bank can give, or maybe the Airbus or the Boeing can arrange it. So let's say I get it arranged from a US bank. So I go to the Citibank. I tell them that, I want a $30 billion loan. So Citibank will say, what is the security that you're giving? I'm saying that it's a loan against a property. The way we do, it's the same way the loan against an equipment. Clear? So many home loans are loans against property, right? In the same way here, you have loans against equipment. But remember, loans against equipments are very riskier. Why? Because the depreciation of your equipments is at a very high rate. So the value of your equity, value of your equipment keeps on falling very faster than your loan repayment. Clear? Everyone? Now, when you provide your house as a security, that's called a mortgage property, isn't it? So when you provide security as your home, that's called a mortgage-backed security. Is that clear? Any questions, anyone?
No.
Finally, you have covered bonds. Covered bonds are a portfolio of bonds. For example, let's say I'm borrowing from you $10 million. Now, what is the security I will provide? I will provide you a security of another portfolio of my bonds, where what will happen that, let's say, if I default on the bond, if I default against a particular bond, then the issuer will indirectly provide you a guarantee that one particular bond which is being defaulted, I will recover that money. Or I will put that additional amount in that investment. I'll explain. So segregated pool of assets called a covered pool, which remains on the balance sheet of the financial institution issuing such bond. Issuer must replace the assets in the cover pool if existing bonds become non-performing. So let's say I have a portfolio of 100 bonds, and if 5 bonds default, I, as an issuer, will take an assurance that I will recover the money. I mean, whatever is the money, I will put my own capital for those 5 bonds. So it's like an insurance. So in the event of default, investors have a recourse to both the financial institution and the cover. Covered bonds usually carry lower credit risk. Why? Because your loan is being covered through some financial assurance by the issuer. Clear? right? Any questions, anyone?
No.
So generally you go to borrow, whether you go through banks or you go to a bond issue. Do you have to provide a collateral? Yes or no?
Yes.
Provide collateral? Yes, you have to provide. For example, if I go to do a home loan, if I go for a home loan, my property itself is going to be the collateral. Or if I go for a corporate loan, I may have to give my financial assets or financial security as a collateral, right? Can I get home loan just on my credit? I mean, just on my name or goodwill? Can I, not home loan, can I generally get a loan just because of my goodwill?
No.
No. What if I am a very well-known celebrity or a very big entrepreneur? Shouldn't I just get loan because I am, let's say, an Ambani, or I am some billionaire sheikh? Shouldn't I just get the loan just because of my name?
Yes.
Why?
Because of the, like, as you said, because of the name.
Okay. So what's in the name? Vijay Mallya got loan based on his name, right? Then what happens? That's the problem. So in UAE, there was this guy called B.R. Shetty. He went to UAE in the year 1975 from India. He hardly had $10 or $20 in his pocket at that time. And by 2020, he was one of the richest person in UAE. His company's value, this company NMC Healthcare value was around $8 to $10 billion on the London Stock Exchange. Can you believe that? From hardly having $10, $20 in his pocket to around $10 to $20 billion of his net worth was there by the year of 2020, within a span of 30 years. Are you getting it? Now, he became a household name in UAE. Everyone knew him. Everyone knew his companies, NMC Healthcare, the UAE Exchange, and so on. Now, he became one of the richest entrepreneurs, the most famous entrepreneurs in the Gulf, right? In the Gulf, there are two famous Indian entrepreneurs, by the way. One was B.R. Shetty and another is M.A. Yusuf Ali, the founder of Lulu. Lulu Hyper chain is a chain which is much bigger than, I should say, any other Indian retail business. It has malls, it has the retail malls everywhere in the Gulf, almost everywhere. So these two Indians were are one of the most famous and richest entrepreneurs in the Gulf. Of that, B.R. Shetty's empire got collapsed in 2020 when it was realized, when it was unearthed that there was a scam, and because of which there were some fraudulent activities in the company's financial statements, and that ended up into a whistleblower probably just describing all this thing, and eventually what happened, the company went crumbling down, and then B.R. Shetty had to run away from UAE and he came back to India and so on. Anyways, that's a different story. But then later on, it was recovered that it was discovered that he had used liability to pay back to the banks, and before paying back, he ran away from the country, from UAE. Okay. And where did he land up? From UAE? He ran from UAE and came back to? He came back to where, He came back to India, his home country, right? Now, isn't the same thing done by many fugitives from India?
Yes.
They borrowed money and they've run back to some other countries in Europe or somewhere, right?
Yes.
And then we are fighting to get them back. But we ourselves also have some of these people who have done fraud abroad and they've come back. You're getting it?
Yes.
So I don't think so. We have right to catch these guys and bring them back when we ourselves have some fugitives in our country who've done scam abroad. Anyways, so that's all politics. I don't want to get into that. But then later on, it was discovered that this particular company NMC was given credit just on the name of BR Shetty by 80 banks, not 1, 2. How many? 80 banks. Are you getting my point? So I'll just show you this snapshot of that heading. What's in the name? Banks count cost of loans in NMC, and they had just given, this guy loan just on his reputation. Are you getting my point? So this is what happens when you just give loans without checking proper collateral, and just because, someone in Rolls Royce has come at your doorstep to take loan. And if you want to check how corrupt your banking system is, go in a normal clothing into the bank and ask for just $1 million loan, and tell them that, I want a loan for building a home, and see how they harass you. They'll ask you for n number of documents and too many visits, and see the way they'll talk to you, right? And then one day go to the same bank, in a lavish car with security guards and so on, and go to the bank and tell them that, what, I need a $10 billion loan for my company. They'll come at your home and give you loan. Okay. They'll come at your doorstep, and then they'll serve you the loan. So I've realized that if you want to borrow for short term, or for, let's say, if you want to borrow for a small amount, just see the banks, how they treat you as in you're doing some crime. But when you want to borrow for billions of dollars, they don't care about what is your credit risk. They are willing to give you very easily. This is very contrary to what people think. And this is how the banking system works, unfortunately. Tell the banks that you need a $100 million loan, and they'll do all up and down to arrange it for you. But tell your bank that you need just 100,000 loan, and see how they treat you. Okay. This is unfortunately the way banking system is. Clear? That's the reason why the poor doesn't get access to capital easily. Clear, everyone? Collateral backing. Any doubts, anyone? Why would you have doubts? Y'all are not even listening, right? See, I told you y'all are not listening. Anyways, collateral. And now the next thing is credit enhancement. What do you mean by enhancement? Enhancement means a boost or a push, right? Now let's say I go to the bank to borrow 100,000. Okay. And the bank tells me that provide me some security. I provide them some security. Now bank will say, no, Kunal, this is not enough. You need to give me something more. Now I can tell them that, what should I give you more? So they will say that, oh, okay, give me some guarantee or some assurance. So then I give them a personal guarantee from my family or relatives and so on. That's called credit enhancement, right? That's called giving extra provisions or extra things to the bank or to the lender, so that they are assured that you will pay them back. Credit enhancements are provisions that can be used to reduce the credit risk, right? Very often used in securitized bonds. So in individual cases, it is very rarely used, but in securitized bonds, because these securitized bonds are riskier, there has to be some credit enhancement. I'll repeat, what is credit enhancement? We'll come to that point. That is just providing some extra layer of security. There are two ways of doing that. One is done by internally, by structuring your organization's bonds, for example, by putting them into the seniority level. I'll discuss that. Or by providing it from outside, which means by providing it through a bank guarantee or an insurance, right? So two forms of credit enhancement, internal and external. Internal relies on structural features, and external relies on the financial guarantees provided by outsiders. So what is internal credit enhancement? Subordination. Subordination means your company's Bond portfolio means the means all the lenders from whom you have borrowed, you have structured them in a manner that the first one will be paid are the senior bondholders, then the subordinate, then the junior. So the bond repayment of your company is structured in terms of seniority. That's called subordination, right? It's a waterfall structure. So the first one will be paid, then second, then the third, and then the fourth layer. So by having a proper structure, you have at least provided, I cannot say you have hedged the credit risk, but you actually spread the credit risk well. Clear? Right?
Yes.
The second is over collateralization. Over collateralization means, let's say I'm going to borrow $100 million. Normally I provide a security of $100 million at least, right? Now I provide you a security more than $100 million. I provide you 110 or 120 million security. That's called over collateralization. That will provide more safety. Clear? Then there are other things like reserve accounts or reserve funds. For example, whatever you have excess of cash, or your operations are generating some excess cash from some of the activities, right? That reserve you can use to repay the loan, right? Second, in securitization, you are the company who has given loans. So you get, let's say the borrowers pay you 8% interest, and you have issued bonds to the investors where you pay them 6% interest. So there's a difference that you earn 2%, right? This 2% profit you do not consume, you accumulate it so that you can use this in the future to repay in case if any of the borrower defaults. Are you getting my point? This is called excess spread. I'll repeat, what is excess spread? When the money you receive, let's say, is at 8% and you have to repay 6%. So this 2% spread is what you can use to collect in case and repay in case if any of the bond defaults. Clear? Right? This
Yes.
process is called turboing. Is that clear? There are too many things to remember. Okay, so I'm making it easy for you all to understand in the concept, but you'll have to read it once. I'm not expecting you to memorize it, but you'll have to read it once, and it's relatively easy. Don't worry. So these are internal credit enhancement. These are more of the structure that you need to change to make the credit risk low or to improve your credibility. Now, if this is not sufficient, you can go for external credit enhancement. External credit enhancement are like issuing surety bonds, means giving some bank guarantee or some, surety bonds are basically issuing insurances. So issued by a rated and regulated insurance company. Such insurance companies are called monoline insurance companies. Now, these companies are famous for ensuring the credit risk of the bond. Are you getting it? So my credit risk is insured by someone else. That's called surety bond. Now, many times banks do this. So when this credit assurance is given by the bank, it's called a bank guarantee. Clear? The same you do it when you do import. When you import from the foreign companies, right? The foreign company asks you for guarantee of payment, right? That guarantee of payment, you get it from your local bank and display it to the foreign company. That is called as letter of credit. Remember that? Have you heard about it? LC? Everyone? So LC or letter of credit is a guarantee by your domestic bank, which you can display to the foreign, seller of the goods. And in return of that, you get goods, right? That is letter of credit. Clear? Now remember, surety bond, bank guarantee, and LCs. In this case, who is responsible to pay to the lender in case of default? That particular bank or the insurance company. Basically the third party, right?
Third party.
So when the third party's credibility is also at stake, you need to check the third party's credibility also. What if the third party itself is a sham company? Then it doesn't matter even if you've given insurance. Are you getting it? Correct. And finally, there is some cash collateral which you can provide in case you can provide some cash account. You can attach some cash account to your particular borrowings in case that will provide you a much better credit risk. So many banks do what? They attach your current account to your loan. So that's the current or your saving account of your company with the loan, so that they probably get a better assurance. This is the way you can do the credit enhancement. The more you can provide credit enhancement, the lower will be your risk and the lower will be your yields. Clear? And let's now understand bond covenants. Covenants means, first of all, bond is a contract. So in contract, what are the things? In contract, there are conditions, right? Or clauses. These conditions or clauses are called as covenants. Everyone. So covenants are legally enforceable conditions or rules that the borrower has to follow. And who puts that on the borrower? The lender. Clear? Of course, both should agree on the rules and regulations. So there are two types of conditions or covenants, affirmative and negative. Affirmative means what should the borrower do? And negative means what should the borrower not do? Clear? So for example, what should the borrower do? The borrower should make timely payments. The borrower should comply with all the guidelines, the laws, the regulation, the taxation and all, right? The borrower should maintain its operational healthy and ensure its assets and pay the taxes when they are due. So the borrower has to be a good boy. That's what affirmative covenants are. The negative covenants, I say the borrower does not have to be a bad boy. So the borrower should what the borrower should not do, or what should they restrict on? There are restrictions on the borrower in terms of raising additional debt, the restriction that they first have to pay the senior debt and then the others, the restrictions on converting uncollateralized assets into a collateralized. Okay, so an asset where there is no collateral provided, you cannot, now you cannot provide a collateral to that asset before others are paid, right? So there are various restrictions. For example, one of the restrictions is that you cannot distribute dividend before paying back to the shareholder, before paying back to the bondholders, right? Very, very natural. You cannot sell off the assets if before disbursing to the bondholders. You need to take bondholders' approval before selling off the assets. What if those assets were provided as collateral, right? So, or they were pledged. So you need to take bondholders' permission. You cannot invest in very risky project, otherwise your bond will be at vulnerable point. They will be at risk. So all these things, or even a merger and acquisition, all these things are restrictions. They can be the restrictions. I'm not saying they are the restrictions in every bonds. Okay, there can be several restrictions on the bond holders or on the borrowers, and those are called negative covenants. We've just seen few of the examples. It doesn't mean that these all restrictions will be there. Okay, so basically any particular bond will have covenants, which are conditions, and these conditions can be the to-do list and to not do list. That is affirmative and negative covenants. We've just seen few of the examples. Clear? Everyone, any questions?
No.
Now comes a very interesting thing. That is the legal and the regulatory constraint. Now, every country has different laws and different regulations, right? Now, for a fixed income, it's a dilemma, because not all bonds are issued and invested in one particular country. There are various bonds which are issued in one country, invested by people from another country in multiple currencies and so on, dual currency bond and all, right? So it's a quite complicated aspect to understand the regulatory part of the bond. Fixed income securities are subject to different legal and regulatory requirements depending on where they are issued and traded, as well as who holds them. But as I said, unfortunately, there is no unified legal and regulatory requirement that is common for all. Why? Because it's a global bond market. Clear? What is a global bond market? Global bond market consists of three major things: national bond market, euro bond market, and the third, which is the mixture of both, that is a global bond market. Okay. So what is a national bond market? Very easy. National bond market is a market where the bonds are domestic or foreign. But why are they called national? Because they're issued by companies of a particular country, either in the same country or in abroad. For example, Apple belongs to which country? Apple Inc.
US.
US. So if Apple issues bonds in US dollar, it's called a domestic bond. Clear? I'll repeat. Apple issues bonds in
US.
in
US.
dollar. It's a domestic
Domestic
bond.
bond.
But if a Toyota or a Volkswagen or a BMW issues a bond in US dollar, then for a US citizen, it's a foreign bond. Why? Because a foreign company is issuing bond in my country, in my currency. You're getting it? So I put up an example. Volkswagen or Toyota issues bonds in US dollar. That's a foreign bond. But both of them are issued in your country, right? So
yes.
The issuer can be your domestic company or a foreign company. But these are bonds issued in your country, in your currency. That's why they are called national bond. National bonds can be issued by local companies, which are called domestic bonds, or foreign companies, which are called foreign bonds. Is that clear, everyone?
Yes.
Right. Now comes a very interesting situation. Now let's say there is an Indian company called TCS, Tata Consultancy Services, an IT giant, right? Now what if TCS issues bond in US dollar in US? I'll repeat, TCS issues bonds in everyone.
In US.
Others. Deep, you there? Divesh?
Yes, sir.
Okay, so this question is for you all. TCS issues bonds in US dollar. What type of bond is it?
Foreign bonds.
Foreign bond. TCS issues bonds in India in rupee, Indian rupee. It's a domestic.
Domestic bond.
But now everyone, when TCS issues bonds in Indian rupee outside India, it's called a Euro bond. Are you getting it? TCS issuing bonds in rupee, but not in India, outside India. It's called a
Euro bond.
Euro bond. Here, Euro means not Europe. It's just a reference for foreign. So when a country issues bonds in its own, when a company issues bonds in its own currency, but outside its country, that's called a Euro bond. So I'll give another example. Apple issues bonds in dollars. I'll repeat, Apple issues bonds in dollars, but somewhere in Germany it issues. Then it's called a Euro dollar bond.
Dollar bond.
Because it's a dollar bond outside US. That's why it's called Euro. Euro is not for Europe. Don't mix up Euro with Euro, okay? Euro is just a reference. I'll repeat, Apple issues dollar bonds outside US. It's called a Euro dollar bond.
Dollar.
So now. Toyota is a Japanese company. It issues yen bonds. Yen bonds outside Japan are called as Euro yen bonds. Clear? Euro yen bonds.
Yes.
The same way, I will now repeat, if TCS issues rupee denominated bonds outside India, it is said to be Euro rupee bonds. Clear? Now, most of these bonds have become very famous and they have a name. For example, Indian bonds issued in rupee outside India are called Euro rupee bonds, right? But now they have a famous name. They are also called as masala bonds. Can you believe that? Masala bonds. I'm not kidding. I'm very serious. What are we known for abroad? What are we known for? What foreigners know us for? Our spices, right?
Yes.
Thank God they have not kept our name as the snake charmer bond. Because people in the West still know us as snake charmer. They have no idea that we are the IT giants of the world. They have no idea that we are the vaccine makers of the world. They still feel us as snake charmers. That thanks to Discovery and National Geography. But otherwise, I've seen many, foreigners fan of India's chicken tikka masala and all, right? I'm sure Deepthi must have experienced how her foreign friends are, and how much they love and fear Indian spices. Correct?
Chicken tikka masala.
Right.
Only that.
Right. So they love it, right? They love Indian spices.
Absolutely. Oh, yes.
But they're even scared of it. So only when they are all prepared to take risks, that's where they have Indian, curries and all. So anyways, so Indian bonds issued outside India in rupee, they are called masala bonds. In the same way, can you tell me what is kangaroo bonds?
Australia.
And these are all real names. These are not my names. Okay. These are not my home cook names. Kangaroo bonds. These are Australian bonds issued outside Australia. Then you have maple bonds.
Canada.
Yes, Canada. Panda. Very easy.
China.
Samurai is
Japan.
Japanese. Bulldog is British bonds.
British.
Pound denominated bonds outside UK. Matryoshka. Anyone? Matryoshka. Russian. That Russian doll, Matryoshka. When I went to Russia, I got that one. Just because, someone told me that it's a lucky charm. I don't know what luck did it bring me, but I just got that Matryoshka. So Matryoshka bonds, Russian ruble bonds outside USSR, outside Russia, sorry. Yankee, very famous. Yankee bonds. US bonds outside US are also called as Yankee bonds. Why Yankee? What is Yankee? The NY Yankee team, their famous baseball team. Are you getting it? So that's how these are Euro bonds. Clear, everyone? What is Euro bond?
Yes.
So the biggest difference between Euro and a foreign bond is if Indian company issues bonds in US dollar, it's a foreign bond for them. But if Indian company issues rupee denominated bonds in US, then it's a Euro rupee or a masala bond. Clear? The trend of Euro bonds started after 1960s when there was the collapse of Bretton Woods, and there was a parallel market for currency bonds outside the country, an unregulated and unsecured market. That's where London became the global hub, and the street on the London, the Canary Wharf, that's where all the banks are today. That became the center of the global borrowing and lending. That's why we have LIBOR, London Interbank Offer Rate, right? That's where the name came from, the Euro dollar bond or Euro dollar market. So next time when you hear this word Euro dollar, it's a borrowing and lending in dollar outside US, which can be any country, not specifically Europe. Clear? Everyone? Anyone? Then there are global bonds. Global bonds are issued by organizations, supranational organizations like World Bank. They issues. Now, what is the importance of global bond? They are issued globally in multiple countries and maybe in multiple currencies. Okay. So what is the situation here? Many investors will invest. So you'll pool money from several investors, right? That's where global bonds are issued. Global bonds are issued for some global purposes. And that's why supranational institutes generally issue global bonds. Is that clear? Right? Now, why does this distinguish matter me? Well, it does matter me because my taxes, my regulations, my laws are going to be different based on where the bond is issued, where the issuer is from, where the investor is from. Based on that, you need to probably consult an expert to understand what are the implications on your bond. Clear, everyone? Everyone, national bond, euro bond, and global bond. Anyone has any doubts?
No.
No? Okay. So what are the tax considerations? Well, we need to see the tax considerations. The important tax considerations here, guys, there are two types of income that you get from the bond. Tell me the two types of income quickly. We just understood that in YTM calculation.
Interest income and the price difference.
That is the capital gain or loss, right?
Yes.
So interest income, that is coupon and the price difference. Correct? Now, mostly your tax is going to be on these two aspects only. What are the different types of tax? First of all, let's understand that there are two types of bonds. One on which you pay tax and another where you do not pay any tax. Those are called tax exempt securities, mostly issued by government. So tax exempt securities are those securities on which you have to pay no taxes on the interest, especially the municipal bonds. Clear? Compared to that, a typical bond, a corporate bond, is the bond where you will have to pay tax on the coupons. And what will be the tax rate? That tax rate will depend on what is the ordinary income tax rate for you. For example, what is the income tax rate in Canada, Deepthi?
40.
40. That is too much.
Yes.
So when Indians crib that 40% is such a high tax rate, and then they run from this country saying that I don't want to stay in this country, and then they go to Canada, and then they realize, oh, it's 40% here. Where do I go now? So I tell everyone, welcome to UAE. Here you have to pay no taxes.
No taxes.
Okay. And UAE is just 3 hours away from India, right? So in case of emergency, India is much better. UAE is much better. So there are countries where you have no taxes and there are countries where you have high taxes. Fortunately for us, we are not in the Scandinavian nations where the taxes can go probably above 50% also. In US, it's around 50%, I think. And in of course, in the European nations, it goes more than 50%. But of course, you have various resources through which you can save taxes and reduce your tax liability. Those you have various options to do that. But just imagine, normally when I teach to my UAE students, and when I say them that we pay 30% taxes, the first question from them is, why? Why do you pay? And then my answer is, we don't have a choice. So paying 30 or 40% taxes, my UAE friends, they are like, why do you pay so much of taxes? Who pays 30% of tax? It's like a shocker to them. But that's lucky we are. We are so lucky that we pay so high taxes, right? We contribute in the nation building, isn't it? We should be paying up high taxes, correct? Just the only problem is that when you pay 40-50% in Canada, you do get something in return. You get some assurance, you get some, social security, you get health benefits and all, assured health benefits and all.
The health benefits are like completely free here.
Yes. And then even if you are unemployed, you get some benefits. Like in US, you get the unemployment benefits and all. Well, that's what you cannot expect in a country of 1.4 billion. Okay. But anyways, I think things are changing. Government is becoming proactive, and I'm an optimistic guy about when it comes to government. And when it comes to people, I'm pessimistic. But I think that, we are living in an era where governments have to constantly improve or they'll be thrown out. So I expect things to change, but still, it's a big difference between what you pay and what you receive. Okay. Yeah. So there are many bonds, especially corporate bonds and domestic bonds. When they pay you interest, that interest is already tax deducted. So let's say if you are going to get 10% coupon and the tax rate is 30%, so you will eventually get 70% only in your hand. Are you getting it? So net of tax interest bonds, domestic bonds are generally net of tax interest. But if there is a euro bond issued, then in that case, you are given gross interest. So then you pay up taxes based on where you are based or from which country you belong. So mostly foreign bonds or euro bonds, especially euro bonds, not specifically foreign bonds also. In euro bonds, the tax liability is handled individually by the investors. Correct? So you get the gross returns. Clear? This is the tax with respect to the coupons. How about capital gains? Capital gains is the difference between at what price you bought the bond and what price you are selling. When will you get a capital gain? If it's a discount bond or if it's a premium bond?
Discount.
Discount.
A discount bond will give you a capital gain, right? So if you hold the bond till maturity. However, there is a possibility that if you sell the bond before maturity also, you can get capital gain. For example, you purchase the bond at 100 and you're selling the bond in between when the bond prices have shot up and you sold the bond at 105. That's where also you make capital gains. Most of the countries in the world have the capital gain in terms of short term and long term. Short term means anything which is less than 12 months and long term which is more than 12 months. So most of the countries have different tax rate for short term, different tax rate for long term. Which one is taxed at a higher rate, short term or long term? Which one is generally taxed at a higher rate, short term or long term?
Short term.
Short term. Why? Because governments wants to discourage people to speculate in bonds. They want people to hold the investments for long. Right? So generally the short-term taxes are higher or they are mapped to your ordinary income tax rate. So for example, let's say if I'm paying 30% tax rate and if I sell the bond within 1 year and if I make capital gains, I'll have to pay 30% tax on it. But if I hold the bond for more than a year, then I may hardly have to pay 10% tax. Clear? So capital gain generally is taxed based on how long you have held the investments. If it is for less than 1 year, you may be taxed at ordinary tax rate. If it is for more than 1 year, then your tax rate is under long-term capital gain, which is relatively very less, right? In many countries, long-term capital gain tax is exempt. So there is no tax if you hold the investment for more than 1 year. However, that depends on country to country. Don't worry, in CFA Institute, you don't ever have to calculate in the level 1 part, you don't have to calculate the tax liability and all. That's not going to be the part of the syllabus here. So don't worry about that. Clear? Right? So I've mentioned not all countries, however, have implemented a capital gain tax. And as I said, it depends on country to country. Now, if it's a discount bond, right? As I said, in discount bond, what happens? You have already bought the bond at discount and you are redeeming at par. So for bonds issued at discount, additional tax consideration related to the tax status of the original issue discount. So here, as I said, you're based on the discount, you may pay up taxes. But tell me one thing in case of a premium bond. In case of a premium bond, do I have a capital gain or a loss?
Loss.
Capital loss, right? So if there is a capital gain, I pay taxes. So if it's a capital loss, I will receive, right? Of course you won't receive. But you will get
Set off.
yes, set off is what we call, right? So you will be able to settle this loss against your gains. So some jurisdictions also have tax provisions for bond bought at premium. For example, if an investor pays 1,005 for a bond for 5 years and redeems at par. So basically, what is your total capital loss? $5 over 5 years, right? So every year, $1 you can reduce your capital gain, or $1 of your amount of gains you can reduce. You can set it off. Are you getting my point? So your overall capital loss is 5. That will be amortized over 5 years. So every year your profits you can reduce by $1. That's a set off, or loss you can adjust. Is that clear? Clear? So you can deduct that $1 from your taxable income every year. Am I clear, everyone? That's the case, but again, you'll have to check out the jurisdiction and whether it is allowed in your state or not. Clear?
It cannot be carry forward, right?
No, that's what I'm saying. So your $5 losses, have to be adjusted within the 5 year of the bond. See, in case of bond, it is very much fixed from day one. So you know what is going to be a capital loss. So that is amortized over 5 years. Okay.
Is it a DTA then? Like,
Yes, it is a DTA. But see, DTA is no. DTA is what? Where you pay now more and later on less.
less. No, it cannot be.
Right? DTA is generally when you have paid existingly more taxes and later on you'll pay less.
Less.
Okay. Clear?
Yes.
Everyone. So that's the second part of our legal, regulatory and tax consideration with respect to bond. Now we will understand the principal and the coupon repayment structure. Basically, we've understood a typical bond where the principal is paid at the principal is repaid by the issuer at the
Maturity.
last, right? On the maturity. So there's a big payment on the maturity. Such bonds are called bullet bonds. Bullet, because at one shot you pay the principal at the last. Clear, everyone? Easy. So what do you pay every year?
Coupons.
Coupon. And you pay the principal at one shot at the last. That's called a bullet bond. Correct. On the extreme end, there is a fully amortizing bond. Fully amortizing bond, it's like a home loan installment that you pay. You remember amortization from cons, amortizing of bonds, right? Equated annual installments. Everyone, should I recollect that? What was that? Amortization. Everyone, remember this?
Yes.
We had done this 25, 30 years back, right? So in amortization bond, every year your cash outflow is same. So your principal is repaid in equal installment, or your principal amount will be repaid in equal phases. Is that clear? That's called a fully amortizing bond. So where will the principal be paid at one shot? In a bullet bond, in equal installment in the fully amortizing bond. Clear? Tell me one thing, where would you pay higher interest? In the total amount of interest paid by the borrower is higher in a bullet bond or in a fully amortizing? Think and tell me.
Bullet.
Why?
Because in the other one, the principal amount is paid, so it is reduced.
Yes, some of the principal is at least repaid,
Amount
right?
is, yes.
Every year. So your liability, outstanding liability keeps on reducing, right? So remember, the bullet bond is the bond where you pay the maximum interest. Clear? Now between this bullet and fully amortizing, you have a partially amortizing bond. In partially amortizing, let's say the bond's outstanding is $100. So out of that, $75 is amortized in the first 5 years, and a big balloon payment, a huge payment of the remaining principal is paid at the last year. So it's not fully amortized and it's not bullet. It's partially amortized. Are you getting it, everyone? Clear?
Yes.
So here, let's say in the first 5 years, you are equally amortizing, and then a substantial part is paid at the 6th year. That's called a combination. It's somewhere between fully amortizing and bullet bond. Clear, everyone? Then you have sinking fund arrangements. Sinking fund arrangements are generally used for utility companies and companies which do huge amount of borrowing, like telecom companies. Many regulators require companies to, when they borrow at huge amount, regulators don't want these companies to end up in trouble and people to lose everything. So they enforce the companies to use a sinking fund provision or sinking fund arrangement. What is a sinking fund arrangement? Let's say, a company, let's say an energy company has issued a $100 billion bond for 10 years. Okay. So if it's a bullet structure, when will the entire principal be paid back?
At maturity.
At the end of 10th year, right?
Yes.
So arranging $100 billion at once at the end of the 10th year is not an easy job for any company. And these companies are highly leveraged and they may end up into trouble. They may not have suddenly $100 billion of cash flow. People are not going to consume power so much at the end of the 10th year that the company will have $100 billion, right? So in such a case, the regulators force the company, they enforce the company to keep a sinking fund provision. So let's say every year, this energy company will keep aside $5 to $10 billion every year. Okay. Now, from their operations, they whatever the money they generate, let's say around $5 billion is what they keep every year aside. What will happen with this $5 billion? What will be done with this $5 billion?
They will reinvest.
No, they will reimburse to some of the bondholders. Out of the $100 billion, they will reimburse to some of the bondholders. Are you getting it? So let's say in the first year, I generated $5 billion. I kept that in the sinking fund. From that, $5 billion will be repaid to some of the investors. The next year, I put $10 billion. So $10 billion will be repaid to some of the investors. By doing that, at the end of the maturity, I may hardly be left with anything. Are you getting it? Clear?
Yes.
Now, all this is properly structured. It's not random amount. Okay, all this is properly structured as to how much amount will be put in the provision in the first year, in the second year, in the third year, and so on. This entire thing is planned. And who takes care of this formal plan? The trustees. The trustees are appointed, and it is the trustee who will ensure that whatever is the fund received, that is reimbursed to the bondholders. Now, which bondholders will be paid out of 100? Well, there can be rules set up for that. Mostly, it's a lottery system. Mostly it's a lottery system. So let's say you invested in this bond for 10 years. And the first year there is a lottery for $5 billion and you receive that lottery. What does it mean? What does it mean?
I'll get repaid.
You'll get repaid. Are you happy or not?
No.
You're not happy because you invested with a vision of 10 years and you got paid it at the first year itself. You face a reinvestment risk for the 9 years, isn't it? Correct? So
Yes.
there is a chance that of course, as an investor, you face huge reinvestment risk. That's a disadvantage you have, right? Especially these bonds are repaid, they are called back at a fixed price. They generally have a call provision here. A call provision, I'll discuss what is a call provision, by which they tell you that we will not pay you more than par. So that's a disadvantage to the investors. Got it? So reinvestment risk and price risk are the two risks that the bondholders face in case of a sinking fund. But if you look from the overall perspective, it's a good structure. Why? Because the companies will not default. So the overall credit risk is reduced. So by the end of the maturity, there's hardly any money left to be repaid. You don't have $100 billion liability sitting on your head on the last day. Most of that you must have already repaid. Is that clear? Everyone? Any
Yes.
questions, anyone?
So there will be no fixed amount of reimbursement.
Reinvestment?
No, reimbursements like.
Reimbursement. So see, first of all that is already pre-decided in the bond indenture. So before you buy the bond, you are aware about the structure. How much money will be put in the sinking fund every year? Okay. So to make it simple, let's say the company is going to do a $10 million every year. So by the end of the 10th year, it will be zero. That's the simplest thing I'm saying. Otherwise, it can structure it the way it wants. But
it can vary also every year.
Yes. But everything will be displayed to you on day zero under that bond indenture. So remember one interesting thing about bond. In bond, if you're going to hold the bond till maturity, everything is fixed. Everything is fixed from day zero. You have the document, nothing's going to change from that. Compared to equity, where everything is uncertain. In bond, everything is certain. Are you getting it? In bond, everything is certain. Clear?
Yes.
That's all about the structure of the bond's cash flow. We understood about the principal and the coupon repayment structure. Is that we understood the principal repayment structure, right? Now let's understand the coupon repayment structure. Well, mostly I've discussed the coupon payment structure. There are two major ways: fixed and floating. In fixed, you'll get the fixed coupon, right? Which can be annual, semi-annual. In floating, it is based on a reference rate called LIBOR. Remember that discussion? Correct? But whether it's a fixed or a floating coupon, does it mean that the bonds will not have credit risk? Well, the bonds inherently have credit risk, whichever type of coupon it is. Okay. Now, one thing that you need to remember, in floating rate, will the coupon amount be constant every year?
No.
It can keep on increasing based on the reference rate in the market. It can go to any level, right? Mostly they are issued, the floating rate bonds are issued with a cap or a floor or both. Cap means the interest rate will not go beyond a point. Floor means the interest rate will not go below a point. Are you getting it? So most of the floating rate notes or floating rate bonds are issued with a cap, which is on your head, and floor, which is at the bottom. Clear? So your interest rate will not go beyond a point and below a point. Is that clear? So can you tell me, if the interest rates are increasing in a floating rate note, you will get more coupon or less coupon? Come on.
More
If
coupon.
interest rates are increasing, you'll get more coupon, right? In a floating rate note. Correct?
Yes.
But in an inverse floater, you will get more coupon if the interest rates are going down. If the interest rates are going down. So any investor who feels that the investor wants to get protected against the fall in the interest rate, they may invest in a inverse floater. What is an inverse floater or a reverse floater? It will pay you more coupon when the interest rates
Goes down.
For example, the structure can be 12 minus LIBOR. So lower the LIBOR, the more is the interest you will get. So let's say right now the LIBOR is 10%. So here you will get only 2% coupon. But tomorrow, if the LIBOR becomes 5%, you'll get 7% coupon, and so on. Clear? Everyone? Any doubts? Fixed. Plain vanilla means fixed. Floating rate and inverse floater. Anyone, any doubts?
No.
Now, what do you see in the diagram? That's the answer. What do you see in the diagram? Is the coupon constant every year?
No.
Okay. This is called step-up coupons. Step-up coupon bonds are those bonds where the coupon keeps on increasing, not constantly, but after a few years. Let's say for the first 2 years, the coupon is fixed. Fixed means 3% or LIBOR plus 1. It can be anything, floating or fixed. But for the 2%, for 2 years, it will, so not 2%, for 2 years, it won't change. Then it will remain constant from 2 to 4, then from 4 to 6, and so on. So the coupon is increasing in stages. Are you getting it? That is called step up coupon bonds. Step up. It looks like steps, right? Everyone clear? So instead of it increasing at a constant, at one go, which is every year different. No, it's not every year different. It's same for the first 2 years, then maybe different for the next 2 or 3 years, and so on. So the coupon increases in stages. That's why it's called step up coupon bonds. Everyone clear? Any doubts? I'll move to the next one.
Yes.
Okay. Credit link coupon bonds. Credit link. They are linked to your credit rating. So tell me one thing. When do you need more protection? When there is a credit downgrade or when there is a credit upgrade? When do you need more protection? downgrade, right? So whenever there is a credit downgrade, you will get more protection in the terms that you will get more coupon. Your coupon will increase. And whenever there is a credit upgrade, you don't need protection. So your coupon will decrease. So credit linked coupon bonds are more like an insurance. Are you getting it? So whenever there is a downgrade, your coupon will
Increase.
Increase. And whenever there is an upgrade, your coupon will go down. But remember one thing. Why? So what happens when there is a credit downgrade? Your coupon should increase, right? But why is there a credit downgrade? Why would the credit rating agencies downgrade you? Tell me.
Because of any previous default.
Because of default, right? Because
Yes.
of the probability of default being increasing. Well, tell me, if the company is already on the verge of default, how can it afford to pay more coupon? Isn't that contrary? Right?
Yes.
Forget about paying existing coupon. Forget about paying that extra coupon. It does not have even money to pay the existing coupon. So it looks very interesting and appealing, but in reality, this credit linked coupon bonds are very risky. Okay, so they may look very appealing, but they are not. Because when there is a severe credit downgrade, of course, technically it says that your coupon should increase, but practically it's very difficult because the company may face severe crisis that it may not even pay the existing coupon. Forget about paying that extra coupon. Clear? So I'm just telling you the flip side of both. Anyone, any doubts?
No.
Right? Okay. Now, let's understand another type of bond, which is generally another type of a coupon, which is generally during the time when the company is facing financial distress. That's called PIK coupon bonds or payment in kind. Here, when the company does not have money to pay you back, what will the company do? Instead of paying you in cash, it will pay you in kind. What can be paid in kind? Well, the company can issue you further bonds. Are you getting it? So instead of I telling you that, I can give you $100 coupon, let me issue you a $100 bond, another bond. So I give you security instead of paying you coupon in cash. Are you getting it? But isn't that very risky? Because I'm not getting my coupon and instead I'm getting more bonds. So it's like, what? The company has issued bonds to pay the existing bonds. Are you getting it? Everyone? So these are very risky bonds. They have a very high yield, but generally companies do it when they don't have a choice. So remember, any companies which issues these type of bonds, they are in deep trouble. Are you getting it deep?
Yes.
Clear? Okay, everyone?
So in, for example, like in $100 bond, there are two, each $100, there are two bonds.
Okay.
Two.
And they have to pay you coupon of, let's say, $10 every year.
Mm-hmm.
So they don't have money to pay you. So instead of that, they'll issue you more bonds. Are you getting it?
Okay.
So I don't have money to pay you, so I'll keep on issuing more and more bonds to you.
But it will be worth of $100, right?
See, whatever it is worth, it's no worth if I don't pay you back. I can issue you thousands of bonds, but what are they worth if I may not be able to pay you back? Okay.
Mm-hmm.
So they are very risky bonds. They are, when the company is at very high debt level, then the companies do that. And remember also, before they pay you this, there is a seniority claim. So that will be paid first and then this bond and so on. So they are very risky bond. Companies rarely do that. And most of the time before doing that, the companies may get burst. Now there is another interesting thing that is called deferred coupon bonds. Deferred coupon bonds. Now I've made a diagram for you to analyze, and can someone tell me what do you judge from this? Both are, let's say, 5 years bond. What can you make out from these? What is a deferred coupon bond?
There's no payment for the first 3 years.
Yes. For the first 2 or 3 years, there is no payment, and then there is a payment, but higher than the typical bond. The coupon is higher than a typical bond. Are you getting it? Correct?
Yes.
So this is mostly, these types of bond are issued by project financing companies, where they may not have cash flows in the initial year, but they are ready to compensate you by paying more cash flows in the later years. Clear? So it is a bond which is sometimes also called a split coupon bond, which pays no coupon in the first few years, but then pays a higher coupon than the otherwise normal bond. So it conserves cash initially so that they can pay you higher coupon later on. It is very common in project financing, since cash flow generation may take time for projects, and they also help you manage taxes. Zero coupon bond can be thought of as an extreme form of deferred coupon bond, isn't it? In a zero coupon bond, what will happen? You'll be not paid any coupon, but later on you'll be paid a huge money on maturity. So that difference may be well enough for you to provide substantial returns. Clear? So in deferred coupon, your coupons are deferred. They are not paid you from the first year. Is that clear? Everyone?
Yes.
And the last type of coupon bonds are index-linked bonds. Index-linked bonds, they are linked to a particular index, especially inflation-linked bonds. They are linked to inflation. Now in US, the inflation is the US CPI, Consumer Price Index, which is like a retail inflation, right? So these index-linked bonds are also called as linkers. What are they called as? Linkers. Why? Because they are linked to something. So if the inflation increases, what will happen? You will also receive more money. Are you getting it? So in 1997, the US Treasury, they issued TIPS. TIPS are US Treasury Inflation Protected Securities, which means when the inflation will increase, as the CPI gets published, and if the inflation is increased, your cash flow will also be increased. The issuer will pay you more coupon. Are you getting it? Inflation-linked bonds are more frequently offered by corporate issues also now. First, it started by the US government. Now even corporates issue that, whether it's a finance or a non-finance company. Why would you invest in such a bonds? To get protected against rise in price, to get protected against inflation, to get hedged against inflation, right? Clear? Now within the inflation index bonds, there are a couple of types. First is a zero coupon index bond and an interest index bond. Now, what is the basic difference here? Now, in a zero coupon bond, only the principal amount changes with the inflation. What changes with the inflation? Only the principal amount, which will be repaid to your maturity. Basically, your par value. So if let's say the inflation has increased by 5%, so instead of $1,000, now you'll get $1,000 plus 5%. Are you getting it? So will your coupons change? Will your coupons change? No. Only the amount which is going to be repaid to you at maturity, that is your par value, only that will be changed. Is that clear? That's called a zero coupon index bond. Clear?
But here it will have no coupons, right?
No. Even if it has coupons, the coupons will not change. The coupons will remain constant. Only your principal at last will be adjusted with inflation. Are you getting it? Don't go by the name. It's saying zero coupon. It means the coupons will not change.
Okay.
Only your principal value will be changed with inflation. They will move with inflation. In an interest index bond, only your interest will change with inflation, not principal. That's the opposite of it. Are you getting it? The difference between two? In zero coupon index bond, what will change with inflation and what not?
Principal will change, not the coupon.
Not coupon. Opposite to that, in interest index bonds, the
Interest will.
coupon will change with inflation, but not the principal. Clear, clear?
Yes.
But in the US tips, which I showed you, US Treasury indexed inflation, inflation protected securities, US tips, which they are called capital index bonds. In capital index bonds, both will change with inflation. Both will change with inflation means
Coupon and principal.
coupon and principal both will change. Is that clear? Right? So let's say there is an increase of 5% in inflation. So you will get more money on maturity and your coupon will also be increased. Clear, clear, clear. So can I say capital index bonds are a combination of zero coupon and interest index bonds? Everyone.
Yes.
Right? Now, what is an amortizing bond? In an amortizing bond, every year you pay some installment, right? Equated installment. So in an index annuity bond, your installment money, which is a principal and interest both, that will change with inflation. So this year you may pay more installment, next year you may pay less installment. It's not going to be constant, but that will keep on changing with respect to inflation. Clear? Everyone?
Yes.
Right? But that was a very lengthy part of principal and coupon repayment structure. But yes, these are the different forms. I've covered all different forms of coupon structure, which you can probably estimate or probably can see. Right? Everyone? Now we are going to discuss the last part, that is callable, puttable bonds, convertible bonds, and coupons and warrants. Everyone. So let's deal with that last part. These are called bonds with contingency provision. Okay. So let's start with callable and puttable bonds. What do you mean by call and put? By the way, have you heard about call and put before? Where is generally
Yes.
call and put used?
Options.
Options, derivatives, right? We'll see that in derivatives at length. But call and put, they are options. Call means an option to buy and put means an option to sell. I'll repeat, call means an option to buy and put means an option to sell. Now, these are contingency provisions which are attached to a bond. Why do I say contingency? Because options are they are contingent. They can be exercised or they cannot be exercised. So they are not sure whether they will be executed or not. So whenever the bond's future outcome is uncertain, in the sense that whether the bond will be alive till the maturity or will be redeemed before maturity or will it be sold before maturity, whenever the maturity part of the bond is not sure, we say these are bonds with contingency provisions, right? Or bonds with embedded options. Embedded means, attached. So there are various types of contingency provisions. We are going to discuss two major of them, that is callable and puttable bonds, right? So for bonds with contingency provisions, as I said, callable and puttable bonds. Now, how will you come to know whether it's a callable or a puttable bond and what are the conditions? Well, of course, that will be mentioned in the indenture and the covenants, correct? Everything will be mentioned there. So let's discuss first what is a callable bond. Remember, what did I say you about call? Call means an option to
Buy.
Means an option to buy. So call means an option to buy. So here it is the issuer of the bond who has the option to buy back the bond from you before maturity. Why would an issuer do that? Let's assume that the issuer has issued a bond for 10 years. For 10 years. But while issuing the bond, the issuer was worried that, I need capital, so I'm raising the funds now. But he's worried, what if the interest rate falls later on? Won't he regret? Won't she regret that, oh, why did I issue a 10% yield bond when the yields have dropped so high? Are you getting it? So the issuer has issued a fixed bond, but somewhere behind the mind, there is a dilemma going that what if tomorrow, tomorrow means, let's say after 2, 3 or 4, 5 years, what if the interest rate comes down? Then I may end up being stuck in a high yield bond, isn't it? Therefore, the issuer keeps an option. Let's say after 3 years, if the bonds yields, if the interest rate goes down, what can the issuer do? The issuer can call back the bond from you and reissue another bond with lower yield. Are you getting it? See, the issuer needed money for 10 years. But after 3 years, what has happened? The interest rates have gone down. So let's assume that the issuer had issued the bond at 12%. Now, after 3 years, the interest have gone down to 9%. Assume that, hypothetically. So what will the issuer do? He will call back the bond, which was issued at 12%, and then again issue bond for another 7 years, maybe at lower yield, isn't it? So the issuer wants to keep this option open in the bond. That's why they may not issue a plain vanilla bond, but they may issue a bond with contingency provision called a callable bond. So who gets the right to call back the bond here? The issuer or the lender?
Issuer.
So who's going to get the benefit here?
Issuer.
The issuer. So what type of risk the lender faces? The lender faces the risk, same like sinking fund, that the lender's bond will be called back before the maturity, isn't it? So can I say the lender faces the reinvestment risk here? Everyone?
Yes.
Clear? So at any point, the issuer feels that the yields have gone down in the market, or if the issuer's credit rating has improved, then it can probably issue a new bond at a lower yield. Then in such a case, the issuer, if has issued a callable bond, can call back the bond and reissue another bond. Is that clear? Right? Everyone? Now, if you see a structure here, there is something that I've mentioned. It's a 10-year bond. It's a 10-year callable bond. What is happening for the first 3 years? I've mentioned something here. What have I mentioned here? Is that visible? What have I mentioned here in the red? Lockout.
Lockout.
What is lockout? Lockout means that for the first 3 years, the issuer cannot call back the bond. So you be rest assured that for the first 3 years, the bond will not be called back. But after 3 years, the issuer has a choice to call back. Clear? So tell me one thing. If you are an investor and you have a choice to invest in a callable bond and in a non-callable bond, what will you prefer?
Non-callable bond.
Everyone? Will you prefer a non-callable bond or a callable bond? Everyone? A non-callable bond, right? So for me to convince you to put your money into callable bond, what will I have to do? I'll have to give you
more coupon,
more yield, or I'll have to issue at a lower price. Clear? Only then will you invest in the bond, right?
Yes.
Clear. So one thing is for sure, for callable bond, the yield is
higher,
or the price is lower than a non-callable bond. Clear? Right?
Yes.
Now, whether there is of course, there is a lockout period of 3 years here, and when the bond will be called back, all this is specified very clearly in the indenture. So you don't have to be worried about that. Correct? Right? So the lockout period here I've mentioned in the example is 3 years. So for the first 3 years, it will not be called back. But after 3 years, the issuer can call back the bond when the issuer feels like. Is that clear? Right? Now, when exactly will the issuer call back? For that, you have to see the exercising options. So that option can be American, European, or Bermuda style option. What is American, European, and Bermuda style option? I'll go to one by one. First of all, let me take European style option. A European style option, and before I go to European and American, let me tell you in the CFA syllabus and in the global equity market. Remember, anything which is good and flexible, anything which is good and flexible is American. Anything which is okay, not that great and a bit rigid or inflexible, you can say, that is European. Clear? So you'll see that very common. Anything which is better is going to be American. Anything which is not better relatively is going to be European. Remember this in the world of finance. Okay. Okay. So here, European option means the issuer can exercise the option of calling back only once after the lockout period. Only once. Clear? Let's say the issuer has decided to call back the bond at the end of the third year. So only once the issuer has to call back. After that, the issuer cannot call back. Clear? But in an American option, the issuer has the choice to call back the bond at any time after the lockout period. Is that clear? So what's the biggest difference between European and American? In European, the bond will be called back only, the issuer has a choice to call back only once after the lockout period. But in American, the issuer can call back the bond after any point after the lockout period. Clear? Which one is better for the issuer here? American or European?
American.
American, because that's more flexible, right? But that's not better for the investor, right? Right. Investor will not want to get into an American bond where the investor has no idea when the bond will be called back. It's so uncertain. Yeah. So there's a fight between American and European. The issuer wants American bond, the investor wants European bond. Somehow they can agree at a Bermuda bond or a Bermuda type of a call option. In a Bermuda type of a call option, yes, it's a combination between European and American. Let's see that. In a Bermuda style call option, the issuer has the right to call bonds on specific dates after the protection period, means after the lockout period. These dates frequently correspond to the coupon payment dates. They have given just an example. For example, here, I say the bonds can be called back. In an American style option, the bond can be called back at any time, right? Right. In a European, the bond can be called back at only once a year, let's say. Clear? But in a Bermuda option, the bond can be called back on a specific dates, multiple dates, even after not once, but multiple dates, but those dates may be fixed. So let's say the first call can be at the end of the third year, the second call can be at the end of the fifth year, and the third call can be end of the seventh year, and so on. So it's fixed. It's decided how much will be called back and on what dates. That's called a what type of a bond? What type of a call option? American or European? Everyone. That's called a Bermuda call option. Everyone. What do you think will be preferred by the investor and the issuer both?
Bermuda.
So most of the bonds that you will see, most of the bonds which have call options in them, or most of the callable bonds are Bermuda style options, where it is good for the investors also and good for the issuer also. In American, it is completely favored on the side of issuer, so it's hardly been subscribed. In European, the issuer finds very less flexibility, so there's no point. So Bermuda is flexible for both. Clear? Now, actually think like an issuer that after 3 years, the yields go down. Then isn't that beneficial to the issuer to go for a callable option and reissue the bonds?
Yes.
But for investor, it's a huge loss, right? Because the investor will now have to reinvest at a lower yield. Correct? So many times the investors don't want to invest in such a bond. Why? Because they will lose out. What will they lose out? Let's say if an investor's bond is being called back. So can I say the investor will lose out a big amount for the next, in this case, let's say 7 years? For the next 7 years, the investor who was supposed to get 12% yield will only get, let's say, 10% yield. So they'll lose out 2% extra for the next 7 years. Correct? Now, many times the issuer is desperate enough to call back the bond and also tell that, don't worry, I will compensate for what you've lost. That's called make whole call. What is that called as? Make whole call. Isn't that sweet enough? Okay. Isn't that? This is actually called, the word that I used, isn't that sweet enough? It's actually called a sweetener in the bond. What is the provision of sweetener? Where the issuer promises that if I call back the bond before maturity, don't worry, whatever is the amount that you have forgone or you have lost, the present value of that, I will pay you back. Wow, such a good thing, right? From the issuer. Why such a good gesture from the issuer? Any idea? Come on, think. Any idea? What would the issuer will gain here? Nothing. But why is the issuer doing this? Tell me, come on.
To attract more investors?
Sorry?
To attract more investors?
Yes. Very good. One reason. Second, what if I don't need money after 3 years? What if my project is done? Isn't it? Then I'm not worried about how much I will save and all. My project is done. I have sold probably the project to someone else. So I don't need the loan. I just want to repay it. So I don't want that extra gain. I'll say, okay, just take this gain. I don't want it. And let me exit from the loan. Isn't it? Correct? Everyone? So two things will happen. One is what Deep said, right? By that I can attract the investors because they'll be, rest assured, they'll be less worried. And second, what if I don't need the loan for 10 years? Then you would probably question, then why did you issue the bond for 10 years, right? Well,
Yes.
there are many projects where you cannot exactly estimate how long the projects will go. And what if in between you find a strategic partner and you sell off the stake? Then for you, the project is done. Are you getting it? It's a very much similar to like, I have taken a home loan for 20 years. But what if at the end of second year, I may get a huge bonus from my company, or I may get huge windfall gains from my company and I pay my loan immediately. Then even if the bank will say, no, Kunal, we will reduce your interest rate from 10% to 5%. I will say, I don't need that 5% also. Why should I pay 5% when I have the money? Let me just pay off and get rid of it. Isn't it? Clear? I may not mind paying some penalty for the bank for prepayment, but I would want to exit. Is that clear? Everyone, make whole call provision. Any doubts, anyone? No? Everyone cleared?
Yes.
That's a callable bond. Remember, call is an option to buy back the bond. Who has this option? The issuer or the investor?
Sure.
The issuer. Contrary to this, there are puttable bonds. In puttable bond, you have an option to sell. Option to sell. So puttable bonds, if callable bonds were for the issuer, puttable bonds are for the bond holders. They have the right to sell the bond before maturity. And why would they do that? Well, if the bonds prices are falling. In such a case, I may want to sell the bonds before it falls more than a value. So puttable bonds are the bonds where the bond holder has the right to sell the bond at a fixed price. Let's say the par value. So at any time your bonds value goes below par, the put option will be exercised and the bond holder will sell the bond at fixed price back to the issuer, and the issuer is obligated to take back the bond at $100 or the par value. Clear? Right? Everyone?
Yes.
So callable bonds good for issuer, puttable bonds good for investor. Clear? Now remember, in a callable bond, when will the issuer call back? If the price goes up or if the price goes down? Not the yield. I'm talking about
Goes down.
I'm not talking about the yield. I'm talking about the price of the bond. Remember, price and yield have opposite relation.
Price goes up.
So, guys, here my question is, a callable bond will be called back when price, first of all, when yield goes down, but I can say price goes up. Clear?
Yes.
So can I say the maximum price is capped? Let's say at par. So the bond's value will never go above par, isn't it? Are you getting it? Yes or no?
Yes.
Everyone, I'll repeat. Callable bond will be called back when the yield goes down or when the prices go up. Right? So bond will be called back. Will be called back when the yield goes down or when the price goes up. And that's where the price is. Okay, so I will write callable bond. Bond will be called when the yield goes down, when the prices go up, and the maximum is capped at par. So the price is, I can say, capped to the top at par. So can the price, will the price ever go above 100 or 1000? No. But the bond will be put or sold when? Sold when? The yields go up, because when the yields go up, the prices go down. Clear? So can I say the maximum that the bond can fall is?
Floor.
Till the floor, which is par. So the bond's value will never go below the par. In which bond?
Okay.
In puttable bond, the bond's value will never go below par. In callable bond, the bond's value will never go above par. Everyone? So can you tell me which bond's price will be highest? Callable, puttable, or non-callable, non-puttable? Non-callable and non-puttable bond are called option-free bond. What are they called as? Option-free bonds. Okay. So which bond will have highest price? Think like an investor. Which bond is best for you? Puttable, option-free, or callable? As an investor, which bond is best for you? So simple question. Puttable bond. So puttable bonds price will be highest compared
Yes.
to an option-free bond, and the least preferred will be the callable bond.
Callable
So
bond.
in terms of price, puttable bonds price will be highest, followed by option-free and then by callable bond. But in terms of yield, you would want the maximum yield in the most riskiest bond, that is callable bond. So callable bonds risk and yield will be higher compared to an option-free bond compared to a puttable bond. Is that clear, everyone? Yes or no?
Yes.
Anyone, any doubts with callable and puttable bonds?
So the callable and puttable are issued at like
At
par.
they
Like
can issue
generally
no.
any.
So
Okay.
issuance is not an issue here.
Mhm.
Redemption is an issue. And first of all, they can be redeemed before maturity. So issue can be at any price. That's
Any
not
price.
yes.
Mhm.
The redemption is an interesting thing here. And the maturity is an interesting, because the maturity is uncertain. That's why they are called bonds with contingency provision, because you have an uncertain maturity. Clear?
Yes.
Now, we will discuss about the calculation of callable bonds, the yield and the price calculation in the next sections, in the reading of valuation of bonds. We will discuss that. So at that time, I'll again come back to this slide. Okay. As of now, we are just discussing the overview. Now, in the same manner, we have convertible bonds. Convertible bonds, we've done some part of convertible bonds where you remember in FRA, where we did convertible debentures and convertible preference shares in the calculation of EPS, right? So what are convertible bonds? Convertible bonds are those bonds which are converted into equity shares at some point of time in the future. So instead of the issuer paying you par on maturity, what will the issuer do? The issuer will give you
Equity.
fixed amount of equity shares, which is already decided at some point of time in the future, right? So basically, why are you investing in a convertible bond? Not just because of you want the coupons from the bond, which is what you get from a straight or an option-free bond, straight bond or an option-free bond, but also because of the potential of equity option. What if the equity prices increase? So you are investing in these type of bonds, not only for the coupon, but also for the equity option into it. Is that clear? What is equity call option? Equity call option is an option where you get benefit if the equity price rises. So here, if the equity price rises, then the value that you are going to get on maturity can be substantially high. And that's the reason why you are investing in a convertible bond. Is that clear? So who gets the right here to exchange the bond against, to exchange the bond and get shares? Who gets the right here? The issuer or the investor? Who has the right?
Investor.
The investor has the right? So at that point in the future, what will the investor get? Investor has the right to convert the bonds into shares. Is that clear? And that's where the investors are willing to invest in such a bond so that they get higher value of shares. So would you be interested in buying a plain vanilla or an option-free straight bond or a convertible bond? What bond will you prefer as an investor? Tell me.
Convertible.
Convertible, right? And that's why convertible bonds are always and always sold at premium compared to an option-free bond. Okay. Why? Because they offer you an option, isn't it? So if the convertible bonds are sold at premium, can I say their yields will be lower or higher than an option-free bond? Interesting question. If the convertible bonds are sold at
Lower.
premium, their yields will be
Lower.
So the issuer has the advantage of issuing convertible bonds. Two biggest advantage. First is that the yields will be low, so they can get the funds easy, right? And second, the issuer does not have to pay cash outflow on maturity. The issuer has to issue shares, isn't it? Right? Contrary to this, what is the investor going to get? The investor has an advantage that on maturity, those shares can be at a higher value. So they have an equity potential, right? And before the bond is converted, they at least get coupons, correct? So they have a potential of higher returns. They have an advantage of yield. Correct, everyone. That's the advantage to the investors. Correct. Now, what is the disadvantage to the issuer? Well, the issuer has a disadvantage that the issuer's equity will get diluted. And the issuer will lose out on the equity potential because the issuer is sharing equity with the bondholders. Clear? What is the disadvantage to the investors? What if the equity goes down? Correct? If the equity goes down, then the investor won't benefit, right? And one more thing here, that to buy a convertible bond, you have to pay premium. That's the cost. What if that shares does not turn up into big benefit? Then you have lost the premium. Is that clear? That's the potential risk. But one thing is very, very, very important in the convertible bonds. What is that? That is the straight value or the floor value. That at any point of time, if the shares, if the bond is converted into shares, right? But what if the share price is very low? If the share price is very low, is that going to be beneficial to the investor? No, right? Now, in such a case, the issuer promises to at least pay you, let's assume a par value on maturity. So let's say the par value of the bond is 1,000. So issuer will pay you at least some minimum value. That's the floor. Isn't that great? That I will at least get par or more if the share goes up. Clear? Are you getting it, everyone?
Yes.
So relatively, convertible bonds are beneficial to the investors, to the bondholders, and therefore they are always and always sold at premium. Is that clear? Now, in level 1, we do not have too much of calculation about convertible bonds. We have that substantial in level 2. But I've put up an example for you all to understand some important terms of the convertible bonds. Otherwise, it's difficult to understand. So I'll first read the example and then I will discuss the terms. Okay, everyone? So what are the key terms in the convertible bond? But before that, let's discuss. What is this example? Can someone read for me? What are the things that I've put here? Everyone? Yes.
Current market price of a share is
of the share of the company which is issuing bond, okay? Not the bond. Current market price of equity or the share is $90.
$90.
Then
current market price of a bond
is 1250. That's the market price of the bond. It's at premium, right? It's at huge value. Clear? Then conversion price. Yes, conversion price of 100. Now, what is conversion price? Can you please read this, Deepthi? Very important. Conversion price. Yes.
The price per share at which the convertible bonds can be converted into shares.
Yes. So, very important. So, when can you convert the bond into shares? When can you convert the bond into shares? When the share price reaches at $100. Right now, where is it?
90.
So, whenever the share price reaches 100 or goes beyond, you are free to convert.
Convert into shares.
Bond into shares. Is that clear? That's called conversion price. So conversion price is that trigger point after which you can
convert into shares.
Bond into shares. Is that clear? Right?
Yes.
Now, how many shares will you get for every bond? That's called conversion ratio. So what is your conversion ratio here?
10:1.
No, 10:1 means what? Can you read what is conversion ratio? The second one, yes.
Par value divided by the conversion price.
Okay, so let's assume your par value is 1000 and your conversion price is 100. So conversion ratio is 10. Par value is 1000, conversion price is 100. So your conversion ratio is 10. What does conversion ratio means? That how many equity shares you will get for converting each bond. So let's say you have your one bond. How many equity shares you will get against each bond?
10.
10 equity shares. Is that clear about conversion ratio, everyone? Correct. Now, what they have asked me to calculate conversion value. So, can you read what is conversion value, Deepthi? Yes.
Share value price multiplied by the conversion ratio.
Yes. So now things conversion value. First of all, on conversion of the bond, how many shares you will get for one bond?
10.
And what is the value of each share now?
90.
So if I convert the bond now, first of all, can I convert? No, I can only convert after the bond has reached the conversion price. But let's assume if I convert the bond now, what is the value that I will get? Only 900. Why? Because the share price is 90 and I will get 10 bonds. So first of all, can I convert immediately? No, I won't convert immediately, right? First of all, you're seeing that not now, but later on the bonds value, later on the equity value will increase and I will get benefit. Are you not paying some extra to buy this bond? Isn't it? That extra is called conversion premium. Can you read what is conversion premium?
Convertible bonds price less its conversion value.
So right now, if you convert, how much will you get? 900. But to convert, you should have the convertible bond. What is the price of the convertible bond as of now?
1250.
1250. So 1250 is the value, is the convertible bonds price against the conversion value as of now is 900. So I'm paying $350 extra, isn't it? Guys, I'm paying $350 extra. Why? Because I feel the share price will increase so much that I will recover this premium, isn't it?
Yes.
I'll recover the premium. So that point at which your share price will reach, so that you can recover your investment in the bond. That is what conversion parity is. So can you read what is conversion parity?
Conversion parity occurs if the conversion value is equal to the convertible bonds price.
So conversion parity occurs. Right now your value of conversion value is 900, right?
900.
When will the parity will happen? When your conversion value will be 1250. Clear? That's your investment in the bond. Now, can I say in order for my convertible value to become 1250, I'm going to get 10 shares. So what should be the share price, guys? The share price should reach at 125. Then my investment will be recovered, isn't it? Clear?
Yes.
So what is the formula that I used? Current market price of bond divided by the conversion ratio.
Conversion.
What did I use here? Conversion parity is current market price of bond divided by the conversion ratio. That will give me parity. What does it mean? That if the share price is right now, which is $90, if it reaches 125, then my money will be recovered. So why are you investing in this bond? You are investing because you are expecting the share price to go above 125. Now, if the share price reaches 150, are you not getting substantial gains? Yes. But what if the share price goes to 0? Well, in that case, you'll at least get the straight value. What is the straight value here? 1000. Clear? Now, ideally, convertible bonds are compared with not option-free bond, but they are compared with stock investment. So now I have a question to the class and you all have to answer me. Assume you have two choices, to directly invest in the stock or to invest in the convertible bond. Which one will you prefer? Had you directly invested in the stock at 90 and if the share price had reached 1500, would you not have made more gain? I mean 150, would you not have made more gains?
Yes.
So then why are you investing in convertible bonds? Because if the share prices go 0, you lose everything in an equity investment. But in the convertible bond, you at least get straight value. And till the time the bond was converted, you at least got the coupons, right? Who gets paid first? Bondholders or equity shareholders?
Bondholders.
Bondholders. Clear? So, you know what? It's a double-edged sword. You pay premium, but you also get a benefit. So you get an upside potential and your downside is also protected. That's why convertible bonds are said to be better at times than direct equity investments. Is that clear? So especially when the markets are not performing good, convertible bond is a much safer option than direct equity investments. In level 1, you do not have calculation about convertible bonds. I have just hypothetically created an example here. In level 1, mostly it's a theoretical part. But in order to understand these key terms, now you can understand these key terms after the calculation that I've done here. Is that clear? Everyone?
Yes.
So convertible bonds gives you that protection. That's why they are better than the direct equity investments. Right? Okay. Everyone, any doubts? Anyone has any doubts? Good. Now, let's move to the last segment of this topic. It's called contingent convertibles, or in the short, they are called COCOs. First of all, convertible means the bonds will be converted into equity shares, right?
Yes.
After the conversion price. But contingent convertibles are mostly issued in Europe, where the European banks force the companies to convert their bonds into equity shares when the companies are not doing good. So this is a trend where the European regulators are very strict. The bonds are contingent. The bonds are contingent means that if there is a write down or if there is a financial crisis in the company, the regulators force the issuers to convert their bond into equity shares. So these are bonds with contingent write down provisions, are convertible on the downside. So when the companies are on the downside, conversion is automatic if a specific event occurs, like a credit default, or when the bank's capital is very low, below the minimum requirement. In such a case, what will happen to reduce the risk of the bank? What will happen? The bank's bond may be converted into equity. COCOs are a ways to reduce the bank's default risk and helps to reduce the risk of the failure of the financial system. So all that bond is probably converted into, by the companies will have to issue more shares, right? That's called contingent convertible. So compared to a normal convertible bond is converted when the prices are increasing. But contingent convertibles are converted. These bonds are converted into equity share when the equity prices are reducing, right? But aren't these very risky bonds? Correct? These are very risky bonds, and therefore they are issued at high yield, because you know what, the company share price is decreasing. So these bonds are more like equities. So they have a very high yield. Clear? Everyone? Any questions, anyone?
No.
So finally, there is something called as warrants. We have discussed some part of warrants in equity investments topic. What are warrants? Warrants are like a warranty. They're attached to a bond. So let's say if you buy a bond, you get a warranty to buy a share at a fixed price in the future. For which you will have to now pay me some premium, right? So let's say today the share price is at $100. I give you a warranty to buy the share after 3 years at, let's say, $125, irrespective of whatever the price will be. So if after 3 years the share price is going to be 500, you'll still have the option to buy it at 125, right? That fixed price. But if they go zero, you don't lose 125 or you don't lose 100, right? But for this, you will have to right now pay me the bond value. Let's say the bond value is 1,000 plus, let's say, $20 premium for this option. So I, as an issuer, I'm able to sell the bond at a better price or a lower yield. So warrants are normally attached to a bond, so that the bond becomes sweet for the issuer, not for the investor. Okay. For the issuer, how? Because the issuer's cost will be reduced. For the investor, it can benefit if the share prices increase. So they are frequently attached to the bond issue and they act as a sweetener. These warrants are actively traded in some financial markets. So these warrants which I've given you, the 100 option at $100, you can buy my bond at $125. Sorry, the strike price of $125. So whenever the prices goes up, right now the premium is $20. The premium will also keep on increasing. It's exactly how call options work. Call options also work in the same manner, right? We will see that in derivatives. Now, because now in today's world, you have call options, which are much better and more liquid and very much traded than a warrant. That's why there are very few companies today issuing warrants. Most of the companies have now stopped issuing warrants. Very few companies issue warrants. But warrants are like, an extra option that you have along with the bond to buy. And that extra option is to buy shares at a fixed price. So even if the prices go up, you are going to end up getting shares at a fixed price if you want. That's a choice that you have. Clear? Everyone? Any doubts? Anyone? Anyone has any doubts? Any questions?
In the tax consideration.
Tax consideration, yes. Yes, tell me.
So what will be the tax consideration for the zero coupon bonds?
So in zero coupon bond, you get only capital gains, right? Zero coupon bonds will have capital gain, isn't it?
Mm-hmm.
So they will be taxed as per the capital gains provision. Because you bought a bond at discount and you're going to redeem at par. So zero coupon bonds generally they face the capital gains tax. Of course, that depends on the rules, the local rules and all, but they don't have to pay. There's no coupon there, so they can be paying up. Let's say your discount is $20 for 5 years. So how much is your yearly discount? $4, right? Correct.
Yes.
If the bond is issued at 80 and redeemed at 100, so let's say the total discount is $20 for 5 years. So every year our discount is $4. So there can be a tax on $4 of your $4 of your notional income. There can be a tax, or there can be a one-way tax directly at the end on $20. But that depends on jurisdictions.
But like if it is $4, for example, then will it not be the interest?
That's what I'm saying.
Income.
See, first of all,
Okay.
there's no interest. It's a notional amount.
Mm-hmm.
But you are certainly going to get the gain of $20, right? So that $20, the government can tell you that, okay, proportionately you pay me $4 of your tax. Or some governments will tell you, don't pay me at the end. Now that depends. So the taxational authority may treat it as a coupon bond or may treat at the end like just a capital. So that completely depends on how they treat it. It's different to different jurisdictions. It's not the same everywhere. So again, we in CFA level 1 don't have to do the tax liability calculations. Absolutely not. But as I said, they can depend, they can vary. Every country has a different rule. Some countries do have a rule of proportionately taxing, right? And that taxation can happen at the income tax rate also, or that can happen at the capital gains tax rate. Some countries do not tax on the proportionate amount. They may tax at the final amount. So again, then that can go as a capital gains tax. For that, you will have to check the local tax rules. And that depends not only country-wise, but even state-wise.
Mm-hmm. Okay.
Clear? Yes. Anyone has any doubts? This is a very vast topic, but it covers various aspects and very essential for us when we proceed towards the calculation part. So do revise it. And when we'll be doing the calculation at that time, I don't want you all to be wondering, oh, what is a callable bond? What is a convertible bond? What is a puttable bond? What is bond indenture? What is covenant? You should be used to these words. Fixed income, I'll repeat what I said in the beginning, that it's a very, very complicated topic. Gradually, the complications will increase. You may not feel it complicated, yes, because I'm teaching, but to be honest enough, fixed income is not easy. And in level 2 and level 3, it's going to be more difficult. So I'm investing too much of time in going into details of it. But what I want from you all is to do revise it once, what we've discussed. Clear? Don't think of it remembering it. Everything is from the name itself. It's very easy. Just go through it once. Is that clear? Everyone?
Yes.
Anyone has any doubts, please let me know, or else we'll meet in the next section.
So far, no doubts.
No problem. So let's meet in the next section. Take care. Bye-bye, everyone.
Bye.
Thank you.